Welcome back. Well, student loan debt is now $1.6 trillion in the U.S. It's caused many young people to have to postpone their lives. They can't buy a home, can't have children, and so forth. But we're talking to a company today that is looking to change that. So welcome Wade Eyerly, the CEO of Education Insurance Corporation, and also Arthur Bevelis, the CEO of Family Office Insight. So welcome. So Wade, start with telling me about the company. What is it that you're looking to do?
Yeah, so what we do is we redefine the student debt market as the largest uninsured investment market in the world. So what we're doing is creating an insurance for that market. So the debt that a 17 or 18-year-old kid takes out, right? They take out 5 or 10 or 20 times their net worth and they make a single investment. They're going to go to college. And normally that investment pays off. But in the event that it doesn't, they set their family back a generation. So what we do is create an insurance product that helps them hedge that risk to make sure that in the event that it didn't work out for them, they had some coverage on that risk.
Yeah, okay. Arthur, I mean, I know you're working with EIC, so what are your thoughts about this space?
It was a really interesting data point that I wasn't aware of, that it's clear that we have a student debt problem, but the data point I wasn't aware of is how badly, if you got stuck in that cycle, it would set back an entire generation because it just acts as friction to drag down that family. And it's not just that family, it has repercussions to the next generation as well. So, you know, there's obviously mechanics that it has to be funded, it has to pay, it has to work for this product to be productive and thwart that problem. So so far we're keen on learning more about how that works.
And what have you seen? I mean, really, like a couple of generations are impacted by this enormous debt.
There's a couple of things people don't realize. 1 in 8 divorces in America now citing student loans as a reason, right? It takes 21 years on average to pay back your student loans. So for the first time in history, when you take out loans today, you will probably still be paying them when your first child says, "Mom or Dad, can you help me co-sign on mine?" Right.
It's like a lifetime debt.
It really can be. And so in the event that if you started college in 2005, your junior year they invent the iPhone and they unlock all this economic potential, and by the time you graduate, Lehman Brothers is bust and you can't find a job. And you couldn't have predicted either of those outcomes. So what we do is we act as a hedge against the downside risk to help people navigate that. It's a risk they quite often don't know they're taking. So in fact, rather than selling it directly to students, we'll actually sell it to universities, so that a college or university is able to say to their incoming freshman class, we guarantee you'll make more money when you go here. One thing people don't realize about the realities of the higher education business of colleges is the proportion of their revenues that are derived from tuition and how devastating a downturn in population is. And the Great Recession of 2008, 2009 shows up 18 or 19 years later in higher education because people didn't have children during that period.
Sure.
So 18 years later, we have a 12, 13% drop in college-age children in the United States. So the competitive landscape for colleges is about to get incredibly intense. So getting ahead of that curve and being able to recruit students by saying, look, we guarantee you'll make more money when you go here. And very, very importantly, being able to keep those students there, increasing the graduation rate. The sad truth is that across all colleges, for-profit, non-profit, public, private, 60% of kids who get to college don't finish. So they take out all this debt and they make an investment that they never get to see the return on. If we can increase that graduation rate, the benefits to the individual, the school, and society in general are massive.
Sure.
So it's a wonderful multiplier effect for the economy.
Well, and we talked about, like, if you would have graduated in 2009, I mean, in the depths of the recession, I mean, if you had even found a job, I mean, you wouldn't have had as much negotiating power, your salary would have started off lower. I mean, you're really kind of starting off down, and so this is one way to kind of mitigate that.
Yeah, you reset your market rate at a low point, and while the economy rebounds, your career never will. We see this all the way back to the Great Depression. You graduate in 1929 or 1930, and you have wildly different lifetime earnings, even though you both lived through the entirety of the Great Depression. Same thing holds true here, and so it's just a remarkably unrealized risk. And so we create this product that's, in one way, it's macroeconomic insurance for the U.S. worker in the United States economy, right? But we share the risk, and in all the good years, right, we're able to cover people for the years where they struggle.
So Arthur, I mean, this is a huge societal problem. I mean, do you know of any other companies doing this? I've never come across it.
Not in this way. There's a variety of things that are arguably in the other side. We have people saying, don't go to college and we'll pay you.
That's right. Yeah.
That's a whole different.
You don't need to go to college.
Yeah, that has gained some traction. But I have a question. So far, obviously, insurance works where you spread the risk and you fund a premium and then you make enough money to pay the people who need it, and the people who don't pay for the people that need it, right? So it's
It's a
the standard.
redistributive, yeah.
How do you, so far, what's the pushback from the universities, if you've had an opportunity to discuss with them? And then how do you thwart the adverse selection part of this?
So one of the reasons we sell to colleges directly is because it addresses that adverse selection piece, right? So when we sell the entire group, you're not self-selecting people that are problematic. Instead, we're able to say, we make a single premium calculation for a university. We cover all your kids for $3,000 or whatever the number is. And then based on your major, you get a different coverage level. So we can give actually real insight to those kids. Right? It's the opposite of the adverse selection. We can help them make good decisions.
So it's a community rating, so you could spread the risk.
So the risk is spread, but if you graduate in computer science, we cover you at $61,000 a year, and if you graduate in something else, it's at a different rate. And so now when you're changing your major, you've got real data and insight into what that means. So there's not a value judgment saying you should chase more money. What it does is let you understand what it means when you're making those decisions in college, which right now happen in a vacuum. Like you don't know what the outcomes are.
No.
You're making the same investment, but you have no idea.
It really
what
is
that
a lot
means.
of risk when you think about it. So I have an 11-year-old son. I think he's going to be college bound. He's already talking about it. So walk me through this as a parent. Like, how do I find out which colleges offer this? What do I have any out-of-pocket expenses? And how will he be insured, less risk in his career?
So you wouldn't have any out-of-pocket expenses. The university would bear the cost. The university's going to do that. So when he's looking at colleges and he gets into University of Michigan and University of Illinois, and one of them offers this program and one doesn't, that's the moment it's going to show up for you and for him, right? Okay. Where he's going to say, all right, I can go to one school that doesn't have it and take the risk on myself. That's what happens today, right? And today, effectively, the wealthy self-insure. Right? If the economy's bad in the year you graduate, the wealthy double down and they go to graduate school and they hide from the economy for 2 or 3 years and they try to reemerge in a different outcome, right? Different economy. If you're poor, if you're first generation student, first generation American, and you've put everything into this degree and you come out in the wrong year, you don't often have that option. Right? And the debt burden is so much that you can't afford to let that ride and continue to accrue, debt while you hide for another 2 or 3 years. You really don't have the same option set. Those are the things that only the wealthy are afforded. And so you see in America for 250 years, we were the best place in the world. If you had been born poor, you had the best chance of dying rich. The highest economic mobility on the planet. We no longer hold that place. We're now 15th in the world in the thing that we're known for, in the American dream, right? And so this lets us get back to that, because the problem there is that servicing that debt is subsuming some of the gain that you used to get from education. So now the wealthy are staying wealthy and the poor are staying poor. We've broken the very thing that helped America sort of become what it is. And with this insurance product, we can help turn that on its head and fix that. We can get that back to the way it's supposed to be.
Yeah. Now, you mentioned, so you have to go state by state because the state governs insurance. So how's that? Is it tedious or?
No, I mean, so you have a 50-state strategy, how you're going to get to each of the 50 states. So today we're not licensed in any of the 50 states, so we can't actually sell the product. But we're in negotiations and talking with the first state we think will get us through. And then you'll go from there. So the upside of a 50-state challenge is that you only need to win one to begin selling. Right? You got 50 battlefields, but one victory lets your company move forward. And then you can use that success to let everyone else sort of look at it and say, okay, we can do it like they did, and you're able to grow.
It's going to sound like I know what I'm talking about, but there are deemer states. So if you get approved in one state, a bunch of others just fall right behind it. And you have to do the protocol. But it's an easier process.
Much easier once you've done it.
Right. Well, like anything in sales, there's somebody who's got to kind of stand out and take the chance, and then everybody else's comfort level kind of comes along.
We like to be out front. One of the advantages here is like those companies like Waymo that have autonomous cars on the road, it'll be very difficult for new startups to catch up because the amount of data they've collected ahead. When we've been building the actuarial tables, when we've been collecting the data around not just first destination outcomes, what the job a student gets, but also the longitudinal data around how that salary or income changes year over year, because we cover you for 5 years after you graduate. That data set doesn't exist anywhere cleanly. And so as we've been collecting that and we introduce the product, we sort of get the same advantage where our actuarial tables, our ability to price this, are always ahead of anyone else who could enter the market doing the same thing.
I see. So how can somebody find out more about EIC?
So eic.co is the website. Easiest thing to do is go there or reach out. We're very easy to find. We've just started talking to folks about sort of the growth plan for the company and what the next stages are.
Okay, you have any kind of vision about when you might be able to be in half the country or something like that? Like,
so our focus is on winning that first battle,
okay.
and the hope is that is in the very, very near term. I'd love to say more, but you don't want to tie a regulator's hands or promise
That's
something
true.
that
And
that we can't
universities
control.
move slow, it seems like, so.
Universities take their time, but that's why they make good decisions,
Yeah.
right? They take their time because they really do care about their students and they really do want what's best for them. So they'll take some time, they'll process. It's totally new. We've yet to meet a university who didn't recognize the strength of the idea. They didn't love it,
Yeah.
right? What we haven't been able to do is quote them a price and tell them what it's going to cost them and have that conversation.
See.
So we're eager to get to that stage.
Well, it seems like they're becoming more innovative too. So the universities they know it's a problem.
Yeah,
and they're trying to figure this
You
out.
see income share agreements, you see free community colleges. Everybody is desperate to find some way to address this challenge because it is so critical to the American dream.
Sure.
I mean, this is the lever that gets you from the circumstance you were born in to being able to die among the most successful people on the planet. And so that education is that lever. And as much as we've sort of broken that with a well-intentioned desire to make sure everyone had access, we've got to now address sort of the follow-on challenges to that. And frankly, at a political level, no one has the winner, right? So we think this issue, this problem, is an apolitical winner. It doesn't matter who stands up and says we're going to do this, but you can, if there's a governor out there that wants to say we guarantee you'll make more money in the state, right? We can buy this for the entire state, and we believe in our students, we believe in our economy, and we believe in our higher education institutions. That is a fantastic way to sort of plant the flag in a state, and we could write the policy such that if you go to school in the state and you get a job in the state, we guarantee you'll make more money and sort of keep those people there. A good example is Wisconsin's #1 export is not beer, cheese, or cars. It's educated 22-year-olds. Yeah.
Yeah. They're going
So being able to keep that educated populace that they've now invested in there and build a tax base there is critically important.
Education's bipartisan.
Yeah.
It sure
Everybody.
is. It's life-changing. I mean, I experienced that. So Arthur, any final thoughts?
The only thing for the lucky few that are members of Family Office Insights, Wade's going to be joining us in the next few weeks to talk about it to the, I'm being kind of sarcastic about the lucky few, but all are welcome.
Yeah.
And going to be talking about the opportunity to the Family Office Insights investor community in the next few weeks.
And what's your website if somebody can't get to a meeting and they want to ask you some questions?
It's kind of top secret, Jane.
Is it? Okay.
FamilyOfficeInsights.com.
Okay, very easy to remember. So finally, real quick question, public and private schools? Mm-hmm. Both, okay.
We'd be able to cover both, for-profit, non-profit, whatever the college is and whatever their outcomes are, we're able to adjust the premiums and the pricing to match.
Okay, awesome. Thank you so much, Arthur and Wade, for joining us, and best of luck.
Thank you.
So,
Thank you, Jane.
and thank you as well for joining us. We'll be right back.